Vanguard suggests that advisors can add up to a half a percentage point simply based on strategic asset location optimization. So what do we even mean by asset location optimization? Spencer, when we build portfolios for clients, we want to think about not just what types of accounts they have. We want to think about their goals and where they're headed, and what can we do to help them achieve those goals without adding undue risk. And so, I think about this. We don't live too far away. We're about a quarter mile from each other. There's a couple ways that I can get to your house. I can walk. It's a nice morning. I typically walk over when we work out. Now, if I'm going to bring you hedge clippers, I don't want to ride my bike with hedge clippers. There's unnecessary risk that I take on when I'm doing that. And similarly, if I want to bring weights down for our workouts, I don't typically want to walk on my back with a whole bunch of weights. And so I'll drive down. There's a lot of ways that I can get to your house, but some ways are more efficient than other ways. So as we think about how we're going to place assets in different accounts, we want to think, what is going to be an efficient way to get there? How can we make sure that clients are going to be able to achieve their goals? So you want us to walk us through maybe some examples of what kind of things do we think about when we think about asset location optimization?
Well, we want to think about two basic areas. First, what is the type of account and what is the type of investment? Some accounts are going to have a treatment on their taxes that's going to be very different than others. So a traditional IRA, a 401k, a Roth IRA, we're not paying tax on those based on their investments on an annual basis. Instead, we're paying tax on, say, the 401k or the traditional IRA as we take distributions. In the Roth circumstance, we'd love to have as much gain there as we can because we're probably not paying any tax on that as long as it's a qualified distribution strategy there. So we also have different rates of return with investments. And so we want to acknowledge those and where we select the vehicles and how we push those into those particular circumstances. So you can see a visual that we're putting up here. And this is what we would call asset location. We're trying to reduce taxes as we think about the way to put pieces together here. You can see on the left-hand side, the vertical axis there, we have a hypothetical rate of return. Now, past performance is no guarantee of future returns, and this is completely hypothetical. There's no prediction that any of these asset classes in a particular year will have a higher rate of return than another. But in this scenario, we have some assets that will give us a greater rate of return and some that will give us typically a lesser rate of return. So if we think about stocks, historically, those have given us a bit better rate of return over long periods of time. Bonds have not given us quite as great a rate of return. So that's the vertical part of the visual here. If we think about the horizontal part, we're labeling the tax efficiency of the asset, the least tax efficient, a moderate tax efficiency, and then the most tax efficient there. And that is with respect to a non-qualified account. So in a Roth or a traditional IRA, for instance, it doesn't matter the tax efficiency of the asset because the tax is not going to come based on what the asset does. It's going to come based on when the distribution occurs. So as we look at that, again, the high rate of return, we have some high rate of return assets like direct lending or alternative lending or even real estate investment trusts that are very tax inefficient. Their income is by and large interest income. Some that are kind of moderate there would be those international and emerging market stocks where there is some interest income there. There is some dividend that may be qualified or not qualified, but there's also usually a higher rate of dividend than what we see in U.S. stocks. The most tax efficient of those investments that are stocks there would typically be U.S. stocks because they have a lower dividend payout over time, and we have the U.S. tax code that is more amenable to U.S. stocks. On the lower rate of return side of things, you can see in the lower right-hand corner there, municipal bonds. So municipal bonds on federal taxes are typically not taxed, that level of income or that level of interest. So oftentimes we can put municipal bonds in a non-qualified account and avoid the interest, tax on interest that would otherwise be there. Now that doesn't always make sense. We have to look at that, municipal bonds versus taxable bonds, and look at a client's circumstances there in terms of their marginal tax rate to determine what might be better. But that's the general layout of this asset location overview.
Yeah. Now, again, we're going to presume as we go forward that all else being equal, it's most efficient to take non-qualified resources first, then pre-tax, then Roth. And so if you want an overview of why we suggest that, or why that's kind of the general baseline, you can go back and watch our other video about distribution strategies, but that's kind of what we're going to start off with. Now, again, in this example, the other piece that we're going to say is let's presume your Roth IRA and your health savings account are invested for a long period of time. You're not starting to take distributions for your HSA, but this is a long-term investment. So there are, again, different distribution strategies based on time and season of life and all of these, but we're going to assume that your HSA is a long-term investment. Let's start off with the low-hanging fruit. We've never met a client that doesn't like tax-free growth.
Oh, yes, please.
You sure?
Yeah. I love some tax-free growth.
Okay, so everybody wants some tax-free growth. And so let's look at our Roth IRA and our health savings account, because those are both in that tax-free growth situation. Now, obviously with your health savings account, with your Roth IRA, they have to be qualified distributions. For the health savings account, you've got to take the funds out for healthcare expenses. That's what the qualification is. Roth IRAs, they have to be after 59 and a half. That's not what we're touching on. We want to think, what are those long-term investments? Again, for this Roth IRA and this client in particular, these are long-term. So as we think about what are the primary investments that we would want to put in either a Roth IRA or a health savings account? Well, you think about US stocks, emerging market stocks, international stocks, direct lending, alternative lending, maybe even REITs. The tax efficiency is pretty, especially on the stock side, there's more tax efficiency, but there's more growth. And that's what we really want to focus on. So with our Roth IRA and health savings account, again, these are long-term investments. So as we look at the chart, we can see that US stocks, emerging market stocks, international, direct lending, alternative lending, REITs, those are the ones that are going to give us the greatest projected hypothetical rate of return. Again, we don't know where it's going, but if we look back at history, those have outperformed. And so we want to think as we move forward, we want those most growth-oriented things for those long-term investments. Now, if a client is going to be taking distributions from their Roth, if they're going to be taking distributions from their health savings account, then we may need to put government bonds or corporate bonds, but those are really a secondary investment to those primary growth-oriented vehicles because these are more growth-oriented accounts. So Spencer, you want to look over at the traditional IRA for us?
Yeah, and as we do that, really the only caveat that we would say there is if we have a lot in Roth and a lot in HSA, then that gives us that flexibility. If we only have a little bit over there, then we may even want to shade that towards direct lending, alternative lending, those types of investments, because we get some nice growth there. And at the same time, we get some tax shielding there. If we had a big non-qualified account, for instance, and a small Roth account, we might try to have that non-qualified account shaded towards stocks, and then the Roth IRA, HSA shaded towards some of these less tax efficient vehicles so that the entire portfolio can be diversified and yet can be growth oriented still. If we go and move over to the traditional IRA side of things, the traditional IRA for a lot of people or 401k assets, that tends to be a significant piece of their savings. So we want to recognize that oftentimes we've got all kinds of different assets there. We've got stocks, we've got alternatives, we've got REITs, we've got corporate bonds, we've got government bonds in there. So oftentimes there's some of everything. The only thing that we typically don't see in a traditional IRA or 401k, a pre-tax 401k type of account would be municipal bonds. There's really not a reason to put municipal bonds there because their yield typically is lower than taxable bonds. So putting them there doesn't really add to that long-term growth story of the overall portfolio. The last piece is that non-qualified account. And this is really a choose your own adventure type of account because we can have clients that they're saving in a non-qualified account for a vacation home purchase in the next 5 years. So we want to potentially invest those resources very conservatively. So it might be mostly municipal bonds there where we're not having tax paid on the interest income. It might be that, as we like to joke with clients, that they're getting greedy for the grandkids, that they don't plan on touching these resources and might not see the resources touched for 20 years, passing them on to a next generation. So they might need to be more in stocks that would never see that capital gain, under current tax law at least, taxed. Of course, there's other types of scenarios where we might need to have some kind of a blended approach there. We might be in a situation, as we've talked about, where distributions are happening from that non-qualified account over the next few years, because that is the least tax efficient account. And if that's the case, then it might need to be conservative for that reason, just simply because to be able to take distributions for living needs, they need to be in either taxable bonds or municipal bonds, depending on a client's tax bracket. So a lot of different complexity there, but we can see that if we look at all three of the investment types there, if we can look at the tax situation and look at how we're going to balance an overall portfolio, there can be some significant gains to our trajectory, just simply by being able to arrange our assets according to their vehicles.
You know, Spencer, we've talked about it several times. There's no one size fits all. So we find it's really valuable to work with an advisor on this. Figure out what is the goal for your investment. Where are you taking these resources? What are they for? Clients, if you want to talk to us about what those goals are and where you should be invested and what assets you want in different types of accounts, we would love to have that conversation with you. Again, this is not prescriptive for any one specific situation, so take this to your financial advisor. And with that, we will talk to you again next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.